Tesla announced the earnings results for the third quarter of their fiscal year. We can see right here from their stock price that their stock's up 86% over the last year. Meanwhile, the rest of the market is up 20%. So Tesla is outperforming the market over the 1-year chart. Everybody really knows what Tesla is and what their business model is, but to talk about it in more detail, first and foremost, the market demand for fully electric vehicles is growing, and Tesla mainly fills that demand. Their business model can be broken up into 3 stages: selling, servicing, and charging. Unlike other car manufacturers who sell through franchised dealerships, Tesla uses a vertically integrated sales network where they manufacture and sell their own cars with external car dealerships completely out of the picture. They have their own website where they sell direct to consumer and their own showrooms to sell their cars all over the world. Tesla Service Support has technicians who fix problems with customers' cars remotely and through house calls. Tesla also builds their own charging stations for electric cars across the country. They have over 50,000 charging stations. Car owners who own Teslas can charge their cars at these charging stations in less than 15 minutes for a quarter of the price of gas. So it's very convenient and it's very cost efficient. Building charging stations for electric cars is really the main bottleneck for the EV industry expansion, which makes the build out of these charging stations by Tesla a pretty big deal. Tesla also builds and deploys solar panels and energy storage units for businesses and residential homes. So to put their business model into simplified terms, Tesla didn't invent electric vehicles, but they did invent a successful business model for bringing compelling electric vehicles to customers. Part of the strategy was building electric charging stations to overcome the hurdle of long distance travel for electric car owners. Keeping control over the sales and service of these cars through their vertically integrated business model is also one of the reasons this company has been so successful. We can see right here that some of the recent news that came out surrounding Tesla is that they trumped one of their main competitors, BYD, in China sales efficiency using a real-time strategy. We can see right here, they point out some key points. Tesla sold far more cars per store than their rival BYD in China. And Tesla, as well as BYD, both grew their market share in China from January to October of 2023. They point out right here that the US car company in the fourth quarter lost its crown as the world's biggest electric vehicle seller to China's BYD, but also that in the first 10 months of 2023, both companies grew their share of the slowing and highly competitive Chinese electric vehicle market. Right here, they point out that Tesla sold more than 1,500 EVs in each of their Chinese stores on average in the first 10 months of 2023, which is up from 1,300 cars per store in 2022. Meanwhile, BYD sold under 600 cars per store in the same 2023 period, which is similar to its 2022 performance, although overall it sold far more EVs than Tesla because of the fact that their models cost half as much as Tesla's, and they also have 11 times as many local distributors. Lastly, right here, they point out that Tesla's EV market share in China grew to 12% in the first 10 months of 2023, up from 10% in 2022. Meanwhile, BYD's share grew to 27% in 2023 from 21% in 2022. So it looks like BYD's market share of the EV market in China expanded a lot faster than Tesla's. So, these are the two main competitors. BYD is obviously backed by Warren Buffett, and there's a bit of a rivalry and some competitive tension going on there. So we'll see which car company ends up taking first place in the future. Now we can see their financial statements. This is their balance sheet. We can see that as of September 30th, 2023, their total assets were $93.9 billion. They had about $39 billion of total liabilities and $53 billion of total stockholders' equity. And then they also had an increasing retained earnings line item from $12.8 billion to $19.9 billion. Definitely a good sign, shows that they have some more cash sitting on their balance sheet that they can use to invest back into their company or also redistribute to shareholders, which typically Tesla doesn't really do. So they'll probably be using that capital to invest back into the company. Now we can get into the juice of the financial statements, their income statement. It was actually pretty interesting for their most recent quarter, in the third quarter. Just some quick tidbit information for you guys. For their third quarter, Tesla's objective was to reduce their cost of manufacturing a single car. The current high interest rate economy is increasing the cost of borrowing for accelerated growth for these companies. So Tesla has opted to instead use this time to invest in research and development and manufacturing so that they can move faster at lower costs in the future. Also, in the third quarter, they reduced their average selling price per car. So for their financial results, we can see that they had revenue in total of about $23.3 billion, up 9% from $21.4 billion year over year. I know it doesn't really point it out in much detail here, but their automotive revenues increased 5% year over year. Their energy revenues increased 40% year over year, and their service revenue increased 30% year over year. So even though their automotive revenues make up the majority of their revenue, their energy revenues have shown the largest amount of growth most recently in their third quarter. Unfortunately, we can also see that cost of revenues increased 20% to $19 billion from $16 billion year over year. So that's obviously a faster increase in cost of revenues than the increase in revenue. Cost of revenues increased 20%, revenue increased only 9%. And as a result, their gross profit fell to $4.1 billion, down 20% from $5.3 billion year over year. Their gross profit margin fell to 18% from 25% year over year. So this is probably part of their strategy in regards to reducing the average selling price per car, but it is taking a toll on their profit margins. They have decreased gross profit in total, and then also a decreased profit margin down to 18% from 25%. Their operating expenses increased 40% to $2.4 billion from $1.6 billion year over year. That mainly came from an increase in their research and development expenses, which increased to $1.2 billion from $730 million. That's an increase of 60%. So this is sort of going along the trend of Tesla prioritizing investing in research and development and manufacturing so they could reduce the cost of manufacturing a single vehicle so that they could move faster at lower cost in the future. But as of today, most recently, we can see revenue is up 9%, cost of revenues are up 20%, and operating expenses are up 40%, with research and development expenses up 60%. That being said, bottom line net income decreased 44% from $3.2 billion to $1.8 billion. So pretty intense drops in profit margin and pretty steep increases in costs for their cost of revenues and operating expenses. But hopefully these increased in costs and these reduced profit margins today will end up resulting in increased profit margins in the future, which would obviously be very beneficial for Tesla's future stock price. Then if we go to page 9 here, we can see their cash flow statement for the first 9 months of 2022 and 2023. Operating cash flow of $8.8 billion, down from $11.4 billion. Their capital expenditures, I know it doesn't really say it here, but their capital expenditures for the third quarter were $2.4 billion, which increased 36% from $1.8 billion. So they invested more into property, plant, and equipment, going along that similar trend of trying to reduce their costs of manufacturing per vehicle. And then also, if you subtract their property, plant, and equipment expenses from their third quarter operating cash flow, their free cash flow was $840 million, which is down 74% from $3.2 billion year over year. So massive drops in free cash flow metrics and profit margin, but hopefully, again, this pays off in the future. And then lastly, right here, we can see their financing activities. Looks like they gained some proceeds from issuance of debt. So they're trying to increase their cash base by taking on loans. And then they also repaid a little bit of debt and then also made some principal payments on their finance leases. So now we can go to the discounted cash flow model to figure out the intrinsic value per share for Tesla. We can see right here, I'm using a growth rate of 30% for the last 5 years because their free cash flow in 2018 was $970 million. In 2022, it was $3.6 billion. And so over that 5-year period, the growth rate compounded annually was 30%. So that's what I'm using for the next 5 years. I'm cutting that value in half for the next 5 years after that to be conservative. The weighted average cost of capital metric that I used to calculate their discount rate comes from this calculation right here. We can see their equity and debt came straight from their balance sheet. They had an interest rate on their debt of 2.17% in their most recent full year, effective tax rate of 20%. The current 10-year treasury yield is 4%. Tesla's beta value is 2.32, which means that they are a lot more volatile than the S&P 500. And so with these metrics in mind, we can see their cost of equity using this formula right here, risk-free return plus beta multiplied by market return minus the risk-free return comes out to 17%. And then we can get the weighted average cost of all of their capital from their equity and debt right here by taking the equity proportion of their capital of their balance sheet, multiplying it by the cost of equity, adding that to the debt proportion multiplied by the cost of debt, and then multiplying the debt proportion by the tax shield because debt is a tax write-off. And so we can see that comes out to 10% to calculate the discount rate for this model. They had free cash flow in their most recent full year of $3.6 billion, net cash of $17 billion on their balance sheet, and then they also have 3 billion shares outstanding. Puts their intrinsic value per share at about $49 per share, which means that at the current share price, they are currently not trading below intrinsic value per share based on those metrics. You'd probably want to buy them at a cheaper share price than $216 per share. But keep in mind, these intrinsic value metrics that I'm using are obviously very conservative. And if Tesla continues to grow their stock price at a similar rate in the future that they were in the past, then based on some other valuation method, you could make the case that Tesla is a good buying opportunity at the current share price. Right here, this is a competitor/industry analysis comparing Tesla to some of their American competitors, Ford and General Motors. I would have compared them to BYD, but I wasn't really sure where to find some accurate financial information for BYD, so instead I decided to use Ford and General Motors. We can see in comparison, Tesla has the highest gross profit margin, net profit margin, return on assets, return on equity. They also have the lowest debt to equity ratio, and then they also have the highest PE ratio, and they're the only company out of the three that does not pay a dividend. So based on this, it obviously looks like Tesla, from a profit margin perspective, is the best company out of the three, and they're also positioned more as a growth company, a growth stock, whereas Ford and General Motors are a little bit more conservative, focused on dividends, and also we can see from the PE ratio, they don't have as much projected growth as Tesla does with a 76 times earnings stock price. Then lastly, I wanted to compare Tesla to some of the other companies we've looked at on this YouTube channel. Tesla did not trade below intrinsic value per share based on those discounted cash flow metrics, so I didn't put them onto our share price compared to intrinsic value table. We can see all of the companies here that were trading below their intrinsic value per share, and also what percentage they were trading below their intrinsic value per share. So Oxy was trading at 9% of their estimated intrinsic value. Kroger was trading 88%. Then if we scroll to the right here, we can see companies ranked in terms of growth rate. Tesla actually comes in at 4th place with a 30% growth rate for the DCF model that we used, which is pretty good, coming in the top 5 here. For gross profitability, Tesla only had a 25% gross profit margin, and net profit margin was only 15%, so it wasn't good enough to get them onto these tables. Adobe and Oxy hold the top profit margins for those tables. For dividend yield, Tesla doesn't pay a dividend. Intel had the highest at 5.52%. And then we can also see that if we're ranking companies based on their Q3 year-over-year revenue and earnings growth, Tesla comes in at 2nd for revenue growth with 9%, but they come in at fourth place with negative 44% earnings growth. Adobe had the highest revenue growth at 10%, and Oracle had the highest earnings growth at 60%. We can see the Q2 table right here. For Q2, it looks like Tesla had the second place growth for revenue at 47%, but they didn't come in for earnings growth for Q2. So if Tesla is able to stay on the Q3 year-over-year revenue growth table, then we'll be able to identify that trend and show that Tesla from quarter to quarter has better revenue growth than a lot of other companies that we've discussed on this YouTube channel in the market. Lastly, we can see right here that Tesla comes in at first place for stock performance over the last 5 years with an 850% return compared to all the other companies that we've looked at on this YouTube channel. So let me know in the comment section down below what you guys think of Tesla. Obviously, this company has historically been positioned very well and has returned a lot of value back to their shareholders. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.